Exchange-traded funds, ETFs, have revolutionized the way investors approach the financial markets. They offer a diverse range of investment options, catering to the specific needs and preferences of investors. Regional bank ETFs, a subset of the ETF universe, have gained prominence for their ability to provide exposure to regional and community bank stocks. In this comprehensive article, we will delve deeper into regional bank ETFs, exploring their construction, notable players in the market, and the factors that make them an appealing choice for investors. What constitutes a regional bank ETF? Regional bank ETFs are specialized exchange-traded funds that focus on tracking the performance of a diversified portfolio of regional bank stocks. These ETFs aim to replicate the returns of an underlying index composed of regional or community bank companies. Regional banks, in this context, are financial institutions that operate in specific geographic regions or communities, catering to localized needs. The selection of stocks in the index typically includes regional banks from various geographic regions, offering investors diversified exposure to this segment of the financial sector. The regional bank landscape. Before delving into the intricacies of regional bank ETFs, it's important to understand the unique characteristics of regional banks and why they are a significant component of the financial sector. Regional banks are often smaller in size compared to their national or international counterparts, and they serve local or regional communities. These banks play a pivotal role in providing banking services to smaller businesses, consumers, and local organizations. They are deeply rooted in their communities, which can lead to a sense of trust and familiarity among their customers. Moreover, regional banks have a nuanced understanding of the local economic landscape, which enables them to make informed lending decisions that align with the specific needs of their communities. This localized focus can be a competitive advantage in serving customers who may not fit the mold of larger, more standardized banking institutions. The need for regional bank ETFs. While regional banks offer a unique value proposition in the financial sector, they can be challenging for investors to access and understand individually. Unlike large national or international banks, regional banks may not have as much visibility or publicly available information. As a result, investors seeking exposure to regional banks often turn to regional bank ETFs, which provide a convenient and diversified way to invest in this sector. 2. The construction of regional bank ETFs. The structure of regional bank ETFs mirrors that of traditional ETFs. They are designed to replicate the performance of the underlying index they track. The ETF's net asset value, NAV, is determined by the total value of the assets it holds, which mainly consists of regional bank stocks. Shares of the ETF are created and redeemed by authorized participants, ensuring that the ETF's market price closely aligns with the NAV. Let's take a closer look at how regional bank ETFs are constructed and what factors influence their composition. Index selection and methodology. One of the key elements in the construction of regional bank ETFs is the selection of the underlying index. The index serves as a benchmark that the ETF aims to replicate in terms of performance. These indices are typically designed to represent the regional banking sector accurately. They may include a mix of publicly traded regional banks, ensuring that the ETF provides diversified exposure to this segment of the financial market. The methodology used to construct the index is of utmost importance. It outlines the criteria for selecting and weighting the constituent stocks. The specific methodology may vary from one regional bank ETF to another, and it can have a significant impact on the ETF's risk-return profile. Some indices may employ market capitalization weighting, where larger banks have a greater influence on the index's performance. Others may opt for equal weighting, giving each constituent bank an equal say in the index's movements. Portfolio composition and rebalancing. Regional bank ETFs typically aim to hold a mix of stocks similar to the index they track. The fund manager responsible for the ETF's day-to-day operations carefully selects and manages the portfolio to maintain alignment with the index. This often involves periodic rebalancing to ensure that the ETF's holdings accurately represent the index's constituents. Rebalancing may be triggered by changes in the index, such as additions or removals of banks or shifts in their relative market capitalizations. The frequency and methodology of rebalancing can differ among regional bank ETFs. Some ETFs rebalance quarterly, while others may do so semi-annually or annually. The choice of rebalancing strategy can have implications for the ETF's tracking error, which is the deviation between the ETF's performance and that of the underlying index. C. Dividend payments. Another crucial aspect of regional bank ETFs is their approach to dividend payments. Many regional banks are known for their dividend-paying capabilities, making them attractive to income-seeking investors. Regional bank ETFs typically pass on the dividends they receive from their constituent banks to their shareholders. However, the amount and frequency of dividend payments can vary among different ETFs. Investors interested in consistent income may prefer ETFs that prioritize regular dividend distributions. In contrast, others may be more focused on total return, which includes both capital appreciation and dividends. The specific dividend policy of each ETF should be considered when selecting the most suitable option for one's investment objectives. 3. Notable regional bank ETFs in the market. Several regional bank ETFs are available to investors, each offering its unique blend of characteristics and features. Some of the notable options include A. SPDR S&P Regional Banking ETF, KRE. The SPDR S&P Regional Banking ETF, KRE, is a popular choice for investors seeking exposure to the regional banking sector in the United States. This ETF tracks the S&P Regional Banks Select Industry Index. KRE's primary focus is on capturing the performance of regional banks operating within the U.S. The index includes a wide range of regional banks, offering a diversified look into this sector. KRE has gained attention for its liquidity and trading volume, making it an attractive option for investors looking for easy access to regional banks. Moreover, KRE is known for its competitive expense ratio, which helps keep the costs of investing in check. As one of the pioneering regional bank ETFs, KRE has set a benchmark for the sector. B. iShares U.S. Regional Banks ETF, IAT. Managed by BlackRock, the iShares U.S. Regional Banks ETF, IAT, is another notable player in the regional bank ETF space. IAT tracks the Dow Jones U.S. Select Regional Banks Index, emphasizing U.S.-based regional banks. With its comprehensive exposure to this sector, IAT provides investors with a way to participate in the performance of local and regional banks. One distinctive feature of IAT is its focus on the Dow Jones U.S. Select Regional Banks Index, which has its own unique index construction methodology. This can lead to variations in the composition of the ETF's portfolio compared to other regional bank ETFs. Investors seeking diversification in their regional bank investments may find IAT to be a valuable addition to their portfolios. C. Invesco KBW Regional Banking ETF, KBWR. The Invesco KBW Regional Banking ETF, KBWR, is designed to track the KBW Nasdaq Regional Banking Index, which includes holdings in U.S.-based regional banks. KBWR's focus on the KBW Nasdaq Regional Banking Index sets it apart from other regional bank ETFs, as this index is designed to capture the performance of regional banks listed on the Nasdaq Stock Exchange. KBWR's unique index choice can result in variations in the ETF's holdings and performance compared to its peers. Investors looking for exposure to regional banks listed on the Nasdaq Exchange may find KBWR to be a strategic addition to their investment portfolios. Additionally, KBWR offers investors a way to diversify their exposure within the regional banking sector. D. First Trust Nasdaq ABA Community Bank Index Fund, KABA. The First Trust Nasdaq ABA Community Bank Index Fund, CABA, takes a slightly different approach within the regional bank ETF space. CABA tracks the Nasdaq OMX ABA Community Bank Index, with a specific focus on community banks and thrifts in the United States. Community banks, by nature, are even more localized and community-oriented than traditional regional banks. Investors interested in supporting community-oriented financial institutions may find CABA to be a compelling choice. This ETF provides exposure to a subset of regional banks that play a vital role in serving the unique financial needs of local communities. CABA's approach aligns with the social responsibility and sustainability preferences of some investors. 4. Advantages of investing in regional bank ETFs. Investing in regional bank ETFs offers several advantages for investors seeking exposure to the financial sector. Let's explore these advantages in detail. A. Diversification. Diversification is a fundamental principle of risk management in investing. Regional bank ETFs inherently provide diversification by offering exposure to a basket of regional bank stocks. This diversification spreads risk across multiple banks, reducing the impact of poor performance by any single bank on the overall ETF's performance. Furthermore, these ETFs often include banks from different geographic regions, further enhancing diversification. This can be particularly valuable in the financial sector, where localized economic conditions and regulations can have a significant impact on individual banks. Diversification helps mitigate the risk associated with these regional variations. B. Accessibility. Investing in individual regional bank stocks can be challenging, especially if you are interested in smaller, less publicized banks. These banks may not be as widely covered in the media or as readily accessible for individual investors. Regional bank ETFs provide an accessible vehicle for investors to gain exposure to this sector without the need for in-depth research on individual banks. Moreover, regional bank ETFs are traded on major stock exchanges, making them easy to buy and sell through brokerage accounts. This level of accessibility allows investors to participate in the regional banking sector with the same ease as investing in well-known, large-cap stocks. C. Professional management. Regional bank ETFs are managed by experienced professionals who make critical decisions about the ETF's portfolio composition, rebalancing, and dividend distribution. This active management ensures that the ETF stays in line with its stated investment objectives and index tracking. Professional management can be particularly valuable in the financial sector, where changes in regulations, market dynamics, and economic conditions can have a profound impact on bank performance. D. Cost efficiency. One of the primary advantages of ETFs, in general, is their cost efficiency. Regional bank ETFs are no exception. These ETFs typically have lower expense ratios compared to actively managed mutual funds, making them cost-effective investment options. The cost savings can add up over time and positively impact the overall returns for investors. E. Liquidity. Liquidity is a crucial factor for investors, as it impacts the ease of buying and selling investments. Many regional bank ETFs, such as KRE, are known for their liquidity and trading volume. This means that investors can enter and exit positions without significantly affecting the ETF's market price. High liquidity is an advantage for both individual investors and institutional investors who may need to execute large trades. F. Transparency. Transparency is a hallmark of ETFs. These investment vehicles provide investors with real-time information about their holdings, including the current portfolio composition and the value of their investments. Regional bank ETFs regularly disclose their holdings, allowing investors to make informed decisions about their investments. V. Risks and considerations. While regional bank ETFs offer numerous advantages, investors should also be aware of the potential risks and considerations associated with investing in this asset class. Let's explore these aspects in detail. A. Sector concentration risk. One of the inherent risks associated with regional bank ETFs is sector concentration. These ETFs focus on a specific segment of the financial sector, which can be vulnerable to changes in economic conditions, regulations, and market sentiment. Regional banks are influenced by factors such as interest rates, credit quality, and the overall health of the communities they serve. A significant disruption in this sector can affect the performance of the ETF. Investors should be mindful of the concentration risk when investing in regional bank ETFs and consider the potential impact of broader economic trends on the sector. B. Interest rate sensitivity. Regional banks are sensitive to changes in interest rates. When interest rates rise, banks may benefit from higher net interest margins, which can boost their profitability. Conversely, falling interest rates can compress net interest margins and potentially impact bank earnings. Given this sensitivity, regional bank ETFs can be affected by changes in interest rates. Investors should consider the prevailing interest rate environment when investing in these ETFs and be prepared for potential interest rate fluctuations. C. Economic and regulatory risks. Local and regional economic conditions, as well as regulatory changes, can significantly impact the performance of regional banks. Economic downturns in specific geographic regions may lead to a rise in loan defaults and non-performing assets for regional banks. Furthermore, regulatory changes can affect the operations and profitability of banks, particularly smaller regional institutions. It's crucial for investors to stay informed about the economic conditions and regulatory landscape in the regions where the banks in the ETF are concentrated. D. Tracking error. Tracking error is the deviation between an ETF's performance and that of its underlying index. While regional bank ETFs aim to closely replicate the performance of their respective indices, tracking error can occur due to factors such as trading costs, management fees, and the ETF's approach to portfolio construction. Investors should assess the tracking error of a regional bank ETF to gauge how closely it aligns with its benchmark index. Lower tracking error indicates a better replication of index performance. E. Dividend variability. Investors attracted to regional bank ETFs for their dividend potential should be aware that the dividend payments from these ETFs can vary over time. The dividend income from the ETF is dependent on the dividends paid by the constituent banks. Economic conditions, bank profitability, and regulatory changes can influence the ability of banks to pay dividends. Investors seeking consistent income should carefully consider the historical dividend performance of the ETF and the dividend policies of the constituent banks. 6. Investment strategies with regional bank ETFs. Investors can adopt various investment strategies when incorporating regional bank ETFs into their portfolios. These strategies are tailored to individual goals, risk tolerance, and time horizons. Let's explore some of the strategies that can be employed with these ETFs. A. Income generation. For income-seeking investors, regional bank ETFs can serve as a source of dividend income. Many regional banks have a history of paying dividends, making these ETFs an attractive option for generating consistent income. Investors interested in this strategy should look for ETFs with a track record of stable or growing dividend payments and consider reinvesting the dividends to benefit from compounding. B. Sector rotation. Sector rotation is a strategy where investors allocate their investments to sectors that are expected to outperform in a given economic environment. Regional bank ETFs can be part of a sector rotation strategy when the financial sector is expected to perform well. Investors can reallocate their investments to regional bank ETFs during economic conditions where regional banks are likely to thrive. Conversely, they can reduce exposure to the financial sector, including these ETFs, when economic conditions are less favorable for regional banks. C. Core portfolio allocation. Investors seeking diversified exposure to the financial sector may consider including regional bank ETFs in their core portfolio. These ETFs can provide broad representation of regional banks, adding depth and diversity to a portfolio. This strategy aims to capture the long-term growth potential of the financial sector while managing risk through diversification. D. Satellite investment. In a satellite investment approach, regional bank ETFs can play a complementary role in an existing portfolio. This strategy allows investors to capitalize on specific opportunities or market conditions within the regional banking sector. For example, an investor with a diversified portfolio may allocate a portion of their assets to a regional bank ETF to take advantage of the potential growth or income offered by this segment. E. Tactical trading. Some investors may choose to actively trade regional bank ETFs to capitalize on short-term market movements or trends. Tactical traders may use technical or fundamental analysis to time their entry and exit points. This strategy requires a deep understanding of market dynamics and carries a higher level of risk and potential for short-term gains or losses. 7. Conclusion. Regional bank ETFs offer investors a unique way to access the financial sector while benefiting from the characteristics of local and regional banks. These ETFs provide diversification, accessibility, professional management, cost efficiency, liquidity, and transparency. However, investors should be aware of the potential risks associated with sector concentration, interest rate sensitivity, economic and regulatory factors, tracking error, and dividend variability. When considering regional bank ETFs, investors should carefully evaluate their investment objectives, risk tolerance, and time horizons. They should also conduct thorough research on the specific ETFs available in the market, examining their index methodology, portfolio composition, and historical performance. Whether used for income generation, sector rotation, core portfolio allocation, satellite investments, or tactical trading, regional bank ETFs can be valuable tools in a diversified investment strategy. As with any investment, due diligence and a clear understanding of the investment's objectives and risks are essential to making informed decisions in the financial markets.